Range-bound or horizontal markets. Now that Zorn has gone over bull trend and uptrend, and bear trend and downtrend, let's see what happens in between. Range-bound or horizontal markets are described as the price bouncing between a high point and a low point of a range. Characteristics are the high is resistance and the low is support. This stems back to support and resistance in buyers and sellers. The multiple touches of the support and resistance areas confirm the range or horizontal channel. It's key to recognize that range-bound markets are formed with horizontal support and resistance levels. So who are the players? Well, our buyers and sellers are coming back into the mix again. We see supply and sellers coming at the range high, and we see demand and buyers coming at the range low. The more touches of either the range low or range high is meaning either party is close to an exhaustion point. We referred back to this as we looked into the first lesson when we went over Japanese candlesticks and overall support and resistance supply and demand zones. So let's take a look at what I mean by this. Here we have a simple chart, and we can see that we have a range high and a range low. Now, if you remember, we have buyers in our demand zone at a range low, and we have sellers in our supply zone at a range high. These horizontals on the top of the range, or the range high, and on the bottom of the range low, are going to define our area where price is ping-ponging back and forth between the buyers and the sellers. Now, at the range low, we want to be buyers at support. At the range high, we want to be sellers at resistance. And going back to what I referred to earlier, the range high is a finite amount of sellers, and the range low is a finite amount of buyers. This is also known as a consolidation phase, where the market is not trending up or down, and this typically precedes a breakout or a breakdown. So let's move over to the chart and see if we can look at this in real time and define some ranges. So here we have our Bitcoin chart. We're looking at a daily time frame, and let's try to pick out some points where we think we could make a range. We're going to start on a high time frame to show you that this type of analysis can be used on daily, weekly, monthly, as well as hourly and minutes. So we can see that we have a high point right here, we have a high point right here, and we have a high point right here. So if I mark this out, I just have the top of my range of a very large time period. Now if I go to the bottom, I can see that I have a low point right here, a low point right here, and a low point right here. This point, the range high, which we can mark out, and the range low is an example of a high time frame range. Now, as we get into ranges later on, what I like to do is I like to mark out the midpoint. So we'll just estimate it around here. Now, what do we see? Something pretty interesting. We have our range low here, and this is 1, 2, coming back to a later point in the market. Notice how price is coming back to these levels at support. The buyers are here, the buyers are here. This marked the bottom. This was a clear indication that buyers were present. Now if we go to the high, we can see that price went up, 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 and where did it stop? In an area which was a pretty big point of breakdown. So we've defined a 1, 2, 3. This is a larger range of a high time frame analysis. Now, if we look at our midpoint, which we're going to get into how to specifically mark it out later on in the advanced sections, we can see that there is a lot of interaction in price here. And price, right here, was in a consolidation zone before breaking out. And we have it returning back here and bouncing right off of here. So as you start to look at charts, we know that there's uptrends and downtrends, and we know that there's range-bound markets on all time frames. So let's mark out a low time frame range and dial in what's going on here. Well, let's take this example down here. So we know that this is our range high, and this is our range low. So as we know, we have this ping-ponging back and forth between sellers and buyers. Now I want you to understand that the range low is not a line in the sand. You can have things called fakeouts or deviations, where sellers have just enough control to push price down, but the buyers come back in. We'll get into range retest lows later on, but recognize that these occurrences can happen. So back to the range. We have our range high, 1, 2, 3, 4, and we have our range low, 1, 2, 3, 4. Now, as we spoke earlier, these are finite areas of resistance or supply by the sellers, and these are finite areas of support and demand by the buyers. Well, let's see what happens. As we notice here, this consolidation zone is getting tighter, and we can see that we have an uptrend developing right here. So if we mark out our chart and say, let's just put the numbers in here, 1, 2, and I like to do this, and I'll tell you why, 3, 4, and let's look at what happens on the 5th touch of a supply zone or resistance, and the sellers gave way. The buyers exhibited an uptrend within the range, and this is what we call a breakout. A consolidation zone or a range-bound market is going to lead to either a breakout or a breakdown. So this is a very nice example of where buyers at the range low took control over sellers at the range high. Now let's take a look at an example where the buyers lost and the sellers won. Well, let's go to right here. Let's mark out our range. Let's call it our range high right here. And let's call our range low right here. Let's zoom in on this section. And if you look, these are very pivotal prices going back in the chart. And this is all going to relate going forward as we look at the support and resistance levels. But let's focus on this right here. So we have our defined range right here. Our sellers are present. Our buyers are here. We are pushing the price up into a supply zone, coming back down into the demand zone. Here the buyers try to push up price through our supply zone where the sellers are present, coming back down. Oh, and what happens? Well, the buyers give way. Here's a consolidation or range-bound zone where the sellers won. So let's take a look. We have our 1. Let's get this guy here. 1, 2, 3, 4, even though it didn't touch the range low exactly, it is close enough because we want to just kind of identify this zone. Remember, this is not a line in the sand, but this is a finite amount of touches, and here we have 5, and who gives way? The buyers. And we have an impulse down and the beginning of a downtrend into our range we just went over. So the important things to grasp are defining the range high and range low, where the seller's supply or resistance is, and where the demand, buyers, and support are. And as we get into later sections, we're going to go over this rule of fives, marking out our midpoint, and looking at the clues that could tell us, are we going to experience a breakout or a breakdown? So let's recap. So we know range-bound markets are not trending and are defined by horizontal support and resistance levels. Range-bound markets can be called horizontals or consolidation phases, and typically are before an expansion or a breakdown. As traders, we want to be focusing on the range low as buyers and range high as sellers. The important thing to remember is both the range high and range low are finite, and to be aware of fakeouts or deviations within the range. So as we move forward and look at the other range sections, we're going to get into midpoint, using Fibonacci, and the rule of fives. But for now, let's take away what we just learned about ranges.